Now, with the Soccer World Cup firmly behind us, the investment spotlight remains over South Africa as the host nation. Recent weeks has seen the JSE continue to record positive investment flows from foreign investors. Now, as these investors search for strong yields outside of their own borders, the question remains as to what opportunities are available for South Africans looking to do the same. Joining me in studio to discuss the much spoken about yet often misunderstood topic of offshore investing is Raylan Dunbar, financial advisor at FinLogic, Mark Green, managing director at Sidel South Africa, and Zamazulu Zulu, account manager at Coronation Fund Managers. Firstly, good evening and welcome to the show. Before we jump into our discussion though, let's take a quick look at a viewer's question received for this week. It comes from Maureen in Waterkloof, and she says, I have inherited a large sum of money from a family member in England. How do I leave the money there? Now, I'm sure there's a lot to consider in terms of winding up an offshore estate, but I think if we had to consider this estate was wound up, the money's now sitting there, what is it that we need to look at, Mark, from your point of view, to keep the money invested offshore?
Well, you know, in terms of inheritances from offshore or foreign individuals, South Africans are not compelled to bring the money back to South Africa in terms of exchange control regulations. So, you know, the person is able to leave the money there, invested in you know, whichever bank or investment vehicles are available. But the important thing is that she does need to register the amount with SARS because any growth, whether it's income or capital, is taxable. And you know, due to us having a residence-based tax system, she will need to declare that on her annual return. But yeah, in terms of the investments, I mean, you get very low yields these days in cash, in pounds and euros and dollars. So probably would need to take some advice and plan ahead with a long-term vehicle.
Now, Raylan, obviously each individual gets 4 million rand allowance to take offshore. Would this be included in that amount of 4 million?
No, this amount is effectively an amount that is, once it's offshore and it is already offshore, it can stay offshore. So any growth or anything that happens on that fund going forward would not be a problem at all. What really needs to be taken into consideration is really, as Mark has already mentioned, is that it just needs to be declared to SARS in South Africa. The idea is if the money is already there, leave it there. You don't necessarily want to bring it back into South Africa and then possibly want to invest it overseas again, because then she will be limited to her 2 million rand that she can take offshore.
Sure. I was under the impression that went up to 4 million. Is it at 2 million still? Or?
No, it has gone up to 4 million.
Okay, so we're at 4 million. I want to get to the taxation side just now because I think it's an important one, but perhaps take a step back for a second and say, well, we know how to leave the money there. I guess the next question is really, Zama, do we have to leave the money, or should we be looking at leaving the money there?
Yes, it is quite all right for the investor to leave the money offshore. And of course, there are many investment options for that particular client. So all she needs to do is most probably seek some sort of financial advice in order to see which option she should really go for. Should she perhaps leave it in an offshore bank account? Should she look at other investment options that can generate some sort of capital growth for her over time? But my best advice would be for that individual to seek financial advice in order to explore various options for her.
Perhaps make an informed decision
That's
from
correct.
there. Raylan, I think you know there is certainly a case for offshore investing. In a nutshell, what would you put that out as?
Offshore investing is really for a person that is looking at a long-term investment. To invest something offshore is not to take money out of South Africa for a 5-year period and then bring it back into South Africa. Most individuals who want to invest and physically take money offshore is in a position where they possibly are thinking of immigrating, or they might have children overseas where they want to leave a certain amount to them in a dollar or in a pound or a euro kind of a basis. So the idea really is wherever you want to spend your money one day, in whichever currency you want to spend it, that is ideally where you should be investing your money. If your goal long term though is to stay in South Africa and always be in South Africa and obviously spend money in South African rands, then very possibly an asset swap is maybe a better option for that kind of individual than physically taking their money offshore.
And which then brings us to probably the next sort of question, that's around diversification. I know for most people where they're using asset swaps, diversification is key, and that's certainly something that a lot of people look towards within their portfolios to perhaps have some offshore exposure to derive some returns. Your thoughts on that?
Yes, no, definitely. I mean, our research at Coronation shows that over time, when you start increasing your international exposure, and we think each individual investor should have at least between 20% and 30% invested in offshore assets. And we think that is the type of exposure that a client will most probably be able to maximize his or her overall returns. And also, because you're coming off a fairly low base, as you increase your returns, you'll also be able to reduce your overall volatility in your portfolio. So, and it's unfortunate that most South African investors have less than that 20 to 30% international exposure. The average investor at the moment has between about 8 and 15%. And we think now is the time for South African investors to actually start considering investing overseas and increasing that international exposure.
Mark Soma picked up an interesting point there. It was really around volatility. And we know that the developed markets generally do sort of grow at a far steadier and more consistent pace than we see in the developing economies. But surely the role of rand and currency fluctuations adds to the volatility and perhaps mitigates some of that stabilization we're looking for.
Yeah, it's a good point. I mean, you know, in general, I mean, 2008 was a pretty poor example of stability in the first world markets, where, you know, it was probably worse than it's ever been in emerging markets even. But, you know, your point regarding currencies is valid. You know, we've seen the rand move from R1.50 to $1 all the way out to 13.85 at the end of 2001, and all the way back to R5.50 again, and now, you know, hovering around R7.50. And it's definitely maybe been a feature in the past. It's been oversold regarding offshore investments. Take your money across, you're going to make huge amounts on the depreciation of the rand. But the truth is that it's been fairly steady in its depreciation over the last 3 or 4 years now. And most economists and most firms are putting the opinion out there that, yeah, we're probably a little bit overvalued right now. So, yes, there is the volatility aspect of it, but in terms of a currency question, it probably still is a good time to externalize rands right now into hard currency.
Absolutely. I mean, there's a massive opportunity potentially lying out there right now for it. Roland, we see that a lot of people, and this is a classic example, you mentioned what's happened in the last decade, maybe even 20 years. Emotions start coming in very, very heavily. People start looking at political and economic factors, and they chase their money out of the country for all the wrong reasons. What is your advice to clients looking at that?
Don't make an emotional decision. I think a lot of people freak out about something happening in the newspapers or something that's going on politically at a point in time, and they think, that's it, I need to get my money out of this country, it's possibly going to be like a Zimbabwe kind of scenario. And people need to take into consideration that that is not necessarily what's going to happen. I mean, we're really in a position where we've got a stable economy. Yes, we've got an emerging market, but the idea really is for investors who want to expose their money offshore is really just in terms of doing it from a diversification point of view, or with a specific point at note as such going forward. You don't really want to be in a position where suddenly you take all your money offshore. And let's be honest, back in 2001, 2002, when it was the flavor of the month to be offshore, everybody went and took money offshore. And the problem is that a lot of investors, excuse me, took money offshore, that they used their full savings and their full retirement plans, etc., and they took that money offshore, thinking that they're going to now make a fortune in terms of the depreciation of the rand. And unfortunately, it was already at the point where the rand had completely turned around. And from that point, the rand recovered very strongly over 2002, 2003. So what's really happened is that over the last decade, people have actually probably lost more money being overseas in offshore funds than if they had actually been in local South African funds. So the idea is do it from a diversification point of view and also from a sector diversification. I mean, South African markets are very, very focused on mining and resources. So the idea really is that if you want to now get exposure into technology markets or chemical markets or manufacturing markets, then that is the reason why you would also look at offshore exposure. And again, not necessarily through physically taking money offshore, but possibly just through an asset swap.
Through an asset swap, yeah, absolutely. Everything you've spoken about now is really around equities, and I think this is an important thing to look at. If we look globally, what you can get in terms of fixed interest and the bond markets, you're pretty much going to get nothing in terms of real returns in South Africa, possibly going to be negative. Is that something for someone to consider?
Oh, definitely. I mean, for us and any other investor for that matter, inflation is always a killer. And if your money has been sitting in some offshore money market type instruments, or even sitting in an offshore bank account, your money is not really doing anything. And when you start taking fees into account, you're actually in negative territory, even if your money is invested in the bank. So if you are looking for those growth opportunities, you need to have some sort of exposure to growth assets. And equities is definitely a good example of those types of assets. Of course, it does come with volatility, and investors will definitely need to be a little bit more patient and be willing to stomach the volatility that comes with investing in equities. But of course, you can always invest in a different type of risk profile portfolio, a multi-asset class type of fund, for example, that can meet your risk profile and your return objectives.
Is that always going to be pegged against global inflation as opposed to local then?
Yes, I suppose so, yes. Because the idea of externalizing your money in the first place is that you don't really want to have to keep on looking at it and converting it into rands. Once your money is overseas, you want to focus more on what is it in that hard currency that you've invested in. And your benchmark, I suppose, even in the overseas market, is cash and, of course, inflation. You want to keep up with that.
Mark, I guess the other thing is then if we're looking at using it for diversification purposes, we're perhaps going to have to go quite heavy on equities offshore. Surely that should impact how we treat our assets locally.
Yeah, I mean, obviously looking at your entire portfolio, domestic and offshore, you've got to take into account your risk profile across the spectrum. You know, while I agree there's a definite opportunity in equities right now in the States, in Europe, possibly in Japan. But the thing is that there are other, asset classes available there. You have a bond market which has performed very well and which we see performing well probably for another year or two at least, because we don't see increases in interest rates happening very soon. And there's also alternative investment strategies which caught a really bad rep, probably deservedly so in 2008,
sure.
But they're out there and there's big solid companies behind them. But yeah, I mean, if you're going to go fairly heavily into equities on your offshore base, you've got to take into account that locally you should balance it out with your more fixed income and property options.
Okay, so balancing is key. A lot of options really available for people both locally and internationally. We're going to take a short commercial break, but when Financially Speaking returns, we continue with our in-depth look at offshore investing.